Vice President. I will now hand you over to Mr. Ibrahim Öz. Please go ahead.
Good afternoon, everyone, and welcome to our first half of 2019 earnings call. In light of the constructive feedback we received with regards to diving straight into our financials, let me therefore commence on third slide of the presentation. After a year of 2018, with the August 2018 lira devaluation and its subsequent reverberations, we managed to achieve some measured growth of our total assets in first half of this year. The funded credits portfolio, as well as funds collected in comparison to end of 2018 first half. In large part driven by the inflation of our balance sheet, stemming from the TL depreciation, our total asset size expanded by 3.9% year to date to reach 43.9 billion Turkish lira. Total funded credits showed 6.1% year to date growth, reaching 27.8 billion Turkish lira on the back of our more cautious approach to balance sheet growth, given the challenges in the operating environment, as well as our emphasis on a more balanced approach to deleveraging the balance sheet. Our funded credit book now constitutes 63.3% of total assets as of first half, and is still an important portion of total assets. Turkish lira funded credits and FC funded credits represented 44% and 56% respectively of the aggregate loan book. Deposits, on the other hand, grew by 15.5% year to date, reaching to 33 billion Turkish lira. The result of this, of course, is that our aggregate loan-to-deposit ratio now stands at around 84%, roughly 1.3 less than the participation banking sector average, and circa 29% less than the banking sector at large, which has a loan-to-deposit ratio of almost 112.9%. Our shareholders' equity increased to 3.29 billion Turkish lira with a 0.8% year-on-year growth. Our capital adequacy ratio declined 83 base points to reach 13.57% as of first half 2019, while our Tier 1 ratio has come down 49 bips to reach 9.44. In terms of NPL volumes, we witnessed an increase of 13.7% in our total Stage 3 credit stock, which reached 2.13 billion Turkish lira at the end of last year. This was more or less in line with the participation bank sector, which witnessed a NPL growth of 14.3 in first half. And the banking sector, which saw a corresponding increase 58.1% throughout the first half. Our NPL ratio did inch up 7.31% from 6.68 at the end of first half. Although I would merely add here that the deterioration in the NPL ratio did not just come down similar to market NPL formation, but rather the muted growth in our overall funded credit books. Our net profit share income declined 31.8 year-on-year to reach 340 million Turkish lira as of first half, This resulted in a net profit share margin of 2.22%, which corresponds to 113 bips year-to-date drop from first half 2018, when it was 3.35%. Net fees and commissions income grew by 72.6% year-on-year, reaching to 147 million Turkish lira in first half of 2019. The growth in this line item is mostly driven by rising revenues from POS services as well as fees on custody accounts, which we have started offering investors. The non-funded credit book has also helped to boost this figure. As a result of ongoing implications of IFRS 9, as well as the rebalancing macroeconomic environment, our provisions for loan losses expand by 16.1 year-on-year, 410 million Turkish lira. Our total coverage ratio stood at around 62.6% versus 66.5% 6 months ago, while our coverage for stage 3 credit stood at 51.9% as of the end of first half in 2019 versus 47.3% at the end of 2018. Total operating expenses grew by 16% year-on-year. However, we have seen a considerable drop in the cost-income ratio, 53.2%, which was 59.7% due to one-off evaluation costs in fourth quarter 2018. HR costs grew by 26.8% year-on-year, while non-HR expenses grew by 2.1% year-on-year. And finally, our net profit came in at year in first half 49.7 million Turkish lira, marking a 74.7% year-on-year drop. There are no doubts that biggest standout development is the considerable drop in the bottom line profitability comparing first half 2019 and first half 2018 as a result of various factors. A gradual and structural change in the funding mix towards more higher pricing competitive deposit products such as TL denominated sukuk, as well as other new industrial products, which is adding to the weighted average cost of funding. Despite the high rate environment, loan repricing on the asset side is coming with a lag, and in our case, particularly taking into account limited new loan growth. The above factors are naturally putting pressure on our operating margins, something we see across Turkish bank sector at the moment, particularly with near flattish lira loan-to-deposit spreads. Again, the inflationary environment is continuing to also pressure operating expenses, and moving forward, we will be in line with our banking peers, continuing to take a close look at how we can increase operational efficiency vis-a-vis cost optimization initiatives. So, as a result of these factors, our reported net profit share margin showed a material drop in 2019 first quarter and continued, stood at 2.22% with a near 58 base points drop over 6 months ago. Overall, our capital adequacy ratio, 13.83, still remains comfortably above the regulatory comfort threshold, 12%, and well above Basel III requirements, 8%, while our core equity ratio drops to 7.12% from the 7.56%. Nevertheless, our AT1 sukuk has provided an additional cushion, 2.37% to the overall capital adequacy. Let me start with the asset segmentation on slide 5 and asset segmentation graph on the upper left corner. Asset composition has somewhat changed as of the first half 19. The fund credit portfolio represents 63.3 as of our total assets, with a 5% decline from a year ago. Our securities portfolio, which now represents 11.6% of total assets, the yield on the securities book has increased 362 base points over last year and 72 base points over the last quarter alone to reach 13.64%. Other liquid assets, consisting mostly of cash and cash equivalents, now represent 20.5%. Obviously, the drop in outstanding funding credits as a percent of our assets has filtered to on the back of our more conservative loan-to-deposit ratios. With regards to these high-quality liquid assets, they now represent 28.8% of all assets. This was a reflection of our balanced approach to ensuring a liquid balance sheet as a mitigant to the challenging operational environment. During second quarter of 2019, our average liquidity coverage ratios on both FC as well as FC plus LC were 238% and 279% respectively. These are well above the regulatory requirements, 80% and 100%. On slide 6 and 7, with regards to operating performance, I am going to now spend some time here going into the individual line items on both the income side and expenses side. Let me begin with the cost and yield movement first. The yield on blended funded credits portfolio increased 72 base points year on year to reach 10.8%. If we look at the blended loan book yield breakdown as of first half 2019, our loan yield was actually 11.90%, representing a 190 base point increase from first half of 2018. Blended cost of collected funds increased 138 base points year on year to reach 7.46%. Reported net profit share margin substantially narrowed 113 base points year on year to reach 255% base points. However, JV adjusted net profit share margin has actually declined by 95 base points year on year to reach 2.19%. Headline quarterly per share income in second quarter of the year increased 16.1% year on year to reach 836 million Turkish lira. Per share income from our fund credits portfolio represents 86.6% of the total per share income in second quarter as our revenue generating assets mostly composed of these credits, while securities portfolio contributed 8.7% of total per share income in second quarter of 2019. Given our strong liquidity position at the moment, due to the lower loan-to-deposit ratio, we believe we are better equipped to deliver stronger lending expansion in remaining part of the year, when we expect to see loan rates in the market at lower levels, which can trigger loan demand and ensure enhanced debt servicing capacity of the borrowers. So we do not expect a structural change in our profit share income composition in the near future. When it comes to details of the yield of funded credits portfolio, we see that Our blended fund credit portfolio yield has increased 110% year-on-year to reach 11.9%. Turkish lira funded credit portfolio yield has increased 640 basis points year-on-year to reach 19.8%. FC funded credit portfolio yield has decreased 100 basis points year-on-year to 6%. Headline quarterly per share expenses increased 47% year-on-year to reach 692 million Turkish lira. Due to the change in our funding mix, as mentioned earlier, and due to the weaker lira, the composition of per share expenses changed in 2018 and in the first half of 2019. 69% of total per share expense was composed of collected funds in second quarter, but this ratio dropped to 61% at the end of this year. The downward path of inflation is supposed to bring down cost of lira funding in the second half 2019, so that our funding mix normalizes in favor of participation accounts. Our blended deposit cost has increased 133 basis points year-on-year to reach 7.46%. Turkish lira deposit cost has increased 453 basis points year-on-year to reach 14.11%. FC deposit cost has increased 37 basis points year-on-year to reach 2.5%. Expenses related to wholesale funding now represents 36 of all our per share expenses. As mentioned earlier, the rising exposure to the lira-denominated sukuks and new competitive return deposit products for customers, as well as the rising cost of FC funding, lifted up the profit share expenses on wholesale borrowings. We will see the expense of wholesale funding cool down after second half of 19 in tandem with the anticipated decline in inflation, as well as our ongoing FC deleveraging on the liabilities side, which will provide the material relief commencing in the second half. Our net per share income came in at 50 million Turkish lira in first half 2019, though contracted by 74% year-on-year. Net fees and commissions reached to 147 million Turkish lira in first half of 2019, circa 73% of year-on-year expansion in this line item is mostly driven by higher POS commissions, custody services, despite the deceleration in economic activity leading to slower loan growth. Net fees related to non-cash credits and banking operations income did also well due to the continued growth of our off-balance sheet business, which had to somewhat offset the lower than expected fees from cash credit business due to the slowing of new cash credits growth. Our trading income for the first half decreased 5% year-on-year to reach 138 million Turkish lira. In terms of the composition of the funded credit portfolio, roughly 44% was TL dominated and 56% of the fund credits FC denominated as the end of first half 2019, whereas our corporate and SME exposure represented 47.1% and 44.2% of the credit portfolio, and retail exposure declining to the roughly 8.7%. Let me also spend some time on slide 8, asset quality, since this is obviously a critical area. Our NPL ratio inched up 7.31% as of the end of the first half 2019, corresponding to the 174 basis point year-on-year increase. While NPL inflows increased in 2019 to the deceleration in economic activity led by the weaker lira, the higher inflation and elevated interest rates, our ratio itself was also impacted by very muted loan growth. Nevertheless, our stage 3 NPL coverage of 51.9% combined with the funded credits or collateralization provides some mitigations. If we take a look at our gross funded credits by stage, what we see is our loan book in terms of stage 1 credits, those without any significant credit risk increase, now represents 78.6% of the total gross funded credits. Our loan book in terms of stage 2 credits represents 14.1% of the gross loan portfolio. Our loan book in terms of stage 3 credits now represents 7.3% of the loan book. In terms of the provisioning ratio, stage 1 0.7% coverage rate, stage 2 has 1.5% coverage rate, stage 3 credits has 51.9% coverage rate. In terms of cost of risk, our trailing 4 quarters gross cost of risk ratio stood at 213 basis points in 2019, with a marginal 14 basis points decrease over a year ago. On slide 9, gross NPL inflows in second quarter of 19 was 154 million Turkish lira, but NPL recoveries increased 59% in second quarter over the same quarter of last year to 70 million inflow, resulting in net NPL inflow of 84 million Turkish lira. Therefore, the net NPL formation rate decreased 112 basis points in second quarter from 250 basis points in the second quarter of 2018. So when we look at the sector distribution in the graphs for the NPL inflows, in terms of the customer classification in 2019, inflows are as follows. So we witnessed a 469 billion Turkish lira gross NPL inflow in first half of 2019. Construction loan files related to construction of power projects, including and manufacturing and the wholesale trade, were the main areas of the NPL inflows came from. When it comes to the sector breakdown for stage 2 loans, which amounted 5.2 billion Turkish lira, construction sector dominated with a 29.8% stake, followed by manufacturing with 23.7%, and energy with the 19.0% stake. Although our cash coverage is low at 1.5 for stage 2 loans, which represents 78 million Turkish lira, we have strong collateral at 4.4 billion Turkish lira. We have 51.9% cash coverage for our stage 3 loans, but again, with Turkish lira 1.38 billion Turkish lira collateral portfolio, we feel comfortable. Slide 10, funding profile. As we already announced the investment community more than a year ago, we repaid our syndicate loans, and we continued in second quarter in April 2019 are 245 million US dollar and 60 million euro syndicated loan, and 5-year 350 million dollar senior sukuk reached maturity in June 2019. We have not tried rolling them over as global funding is increasingly becoming a drag on per share expenses given the rate increase and currency impact. We have seen in subordinate loans in our overall subordinate debt from 1.2 billion as of year-end 2018 to 1.3 billion Turkish lira as of first half of 2019. These loans represented 3% of all liabilities. Shareholders' equity represents 7.5% of all liabilities, so our total shareholders' equity is to the same level, 3.29 billion Turkish lira. On slide 11, funding profile slides, our aggregate deposit base increased circa 15.4% year to date in first half of 2019 to reach 33 billion Turkish lira. The breakdown of these collected funds in terms of how much are sitting in current accounts versus participation accounts for the end of first half was 32.7% and to 67.3%. The breakdown of our total deposit base for the same period in terms of TL denominated versus FC denominated funds was 34% and 66% respectively. In terms of underlying trends, Turkish lira current accounts increased 3.5% year to date. Turkish lira participation accounts contracted 6.7% year to date, and with these collected funds, overall Turkish lira total funds increased 1.6% year to date. When we look at the FC funds, FC current accounts increased 22.4% year to date in real terms. FC participation accounts increased 16.1% year to date in real terms again, and FC total funds contracted 2.5% year to date in real terms. The contraction in Turkish lira participation accounts was mostly captured by migrations to the newer price competitive deposit products I mentioned earlier, albeit at the marginal cost of profitability. In terms of cost of funds collected, Turkish lira cost of funding has increased 453 basis points year on year to reach 14.11. FC cost of funding has increased to 2.50%. Average cost of funding has increased 130 basis points year on year to reach 7.46%. On slide 12 of balance sheet assessment slides, total of balance sheet commitments increased 1.5% year on year to reach Turkish lira 13.8 billion for the first half 2019. In terms of breakdown, 60% of these commitments are LGs, letter of guarantees, 10% of these commitments are LCs, and 30% of commitments are other items such as irrevocable commitments, derivative financial transactions. Trends-wise, there is a healthy growth across all the main areas. The growth in this area is a reflection of efforts being placed to continue to position our bank as an SME-friendly institution which can meet all the trade finance requirements of our customers. This being matched by an active FI strategy to expand our correspondent bank network. Slide 13, income cost dynamics slides. I think we have gone into most of these dynamics in some detail earlier in the call. On slide 14, financial ratios, sector comparison. Again, the financial ratios reflect a fairly clear picture for us all. I believe we are facing the same headwinds and trends, albeit to different degrees. We are going through a period of operational margin pressures given temporary market dynamics and naturally witnessing the pass-through effect of August 2018 Turkish lira depreciation on asset quality and provisioning, which combined with the inflationary pressures on other operating expenses are all pressuring bottom line profitability. Yet we are cautiously optimistic that a turnaround after second half of 2019 is very much on the cards. We believe we will be well positioned to see recovery as a result of our sound liquidity and conservative LDRs, which give us a room for credit expansion. This brings us to the end of our financial results presentation. Thank you for taking time to join us on this call.